You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Hello and welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, last week on the podcast, we took a little time out to answer some listener questions. Mark Longo from Options Insider was a gracious host for the event, and we answered as many questions as possible. Those are by far my favorite shows to do on Options Playbook Radio because the listeners of the podcast always come up with some great questions. Prior to that, the last few trades that we looked at, paper trades, I should say, on Options Playbook Radio, are actually speculative trades. We went back and looked at buying some out-of-the-money calls, and the most recent trade would have expired on February 17th, which was on Booking Holdings, the old Priceline, used to be known as Priceline, and it was leading into their earnings. We did a long call spread, and we needed a fairly significant move in the underlying stock, and we did it before the earnings report, quite a bit before, about a week before that earnings report. So we did have a run-up in the underlying stock going into the earnings, and as we mentioned on the call, if you do get an opportunity to get out of a trade prior to the big event, because the market goes with you, you just do it. If you can basically inside of the trade in the long call spread on Booking Holdings, we were able to almost double what we paid for the trade, before that earnings event, then just get out. So it was a very simple, wouldn't even have gone to the risk of the earnings, just would have closed the trade out before that announcement even happened. We needed the market to get to 25.10. After the earnings, there was a little bit more chop in the marketplace. Market came down a little bit, kind of hung around the 2,500 level, a little bit more to the downside on that. But now we see the market actually fairly strong, and today we have it up 20 points, or almost 1%, and the Booking Holdings is trading at 2,541-ish. And I should mention that we are taping Options Playbook Radio on a Tuesday. The markets are open and rocking and rolling. All right, so with the choppiness of the marketplace and the recent increase in the VIX index up over the 20% level, the strategy that I focused on, I would say about a month ago, is the Iron Condor. And that really kind of fits the marketplace if you continue to see the chop and the S&P 500 index just staying right around that 4,000 level. doesn't really want to break to the downside, but it doesn't really want to break to the upside either. So based off of the news events of the day, either we're up a percent or two, and then before you know it, we get another news event and we're down a percent or two. So that is the strategy that kind of fits the marketplace, and that's what Options Playbook Radio is all about. We're just trying to take one of the 40 plays and look at what's going on in the marketplace and try to fit the strategy to match the marketplace. Now, nothing is ever meant to be a recommendation here on Options Playbook Radio. We're literally just trying to learn. So with all that mentioned, the fact that it's really hard to get a direction of the marketplace, we've been speculating on a few underlyings around their earnings reports. And we're going to continue the speculation, and it doesn't have anything to do with earnings, but just because of the choppiness of the marketplace, we're going to look at some of the commodities. Instead of just trying to pick a stock, if you look at oil and what has happened with a barrel of oil recently, today we actually have it up about 2.5%. But right now we see a barrel of oil is trading on the futures market around $78. It's up about $2 on the day today. And we're going to use the USO to try to speculate on an upward movement in the price of oil going into the summer months. Why not, right? So what it really comes down to, if we're going to speculate, how are we going to use options to speculate on an upward price movement in the underlying stock? Now, when we looked at Booking Holdings, it was a very expensive underlying. As we mentioned, we wanted the underlying stock to get to $2,510. And because of that, we looked at a long call spread. Now, today, we're going to speculate on the price of crude oil, and we're going to use the USO. Now, I also want to let you know that there is a USL, which is a little bit more long-term focused on the price of oil using the futures contracts. And I do like the USL because we're going to go out a little bit further in time, but the options markets aren't as tight. So because I would prefer to have tighter option markets when we're doing our paper trade today, I'm going to stick in the USO. It's just that simple. It just has more volume in the underlying, and because of that, we get tighter bid-ask spreads in the options marketplace. So in our trade today, we're going to look at the July 21st expiration. And we're going to go a little bit out of the money. That's 143 days away. That's the days to expiration on the July 21st expiration. We're going to go a little bit out of the money. So this is what really makes it speculative to me. Well, it's speculative because, first of all, we're dealing with a commodity. We're dealing with oil and oil prices. So that's going to add to the speculation. This is an ETF that actually tracks the futures contracts on the oil. That also adds a little bit more to the speculation. And if we were to be a little bit more bullish, we would be looking at a more in-the-money option contract, maybe the same expiration, but we'd be looking to spend a little bit more and buy a contract deeper in the money that acts a little bit more like the underlying, giving you a little bit more delta. In this case, we're going to go out of the money. And when I go out of the money, I want to go a little bit longer term. What happens when I go longer term on out of the money options? Well, first of all, I have to pay more. That's not good because time is money. So the further you go out, the more you're going to have to pay. But you picked up delta. Your option contract will act a little bit more like the stock the further you go out in time. So you get decent price movement when the underlying, well, in this case, ETF actually moves. And even though I paid a little more, I do get a little bit more reaction to the marketplace. And then also we have the slower rate of time decay. So the strike that we're going to buy with the USO trading at 67.85. I just took a snapshot of it. Like I said, the markets are moving on this Tuesday morning. And we see that market is 545 by 590. Now, the open interest on this one contract is almost 4,000, so we got a decent amount of open interest. We have a little bit of volume going into the options today. And once again, the bid-ask spreads are a little bit wide on this underlying. That's part of the reason why we're looking at the USO. So I would try to work the trade a little bit. I'm going to say that we could see it at the midpoint, and the midpoint of it, so we'll make it simple. We'll call it 575. Now, there is, it's harder to fill an individual option contract at the midpoint. So there's no guarantee that you would ever get a midpoint fill on that trade, but that's where we're going to work with. We could say 590 if you wanted to, but we're going to look at the midpoint right around 575. That means we're going to invest $575 plus commission to get into this trade. Now, I do not plan on riding it all the way to the expiration date. July 21st gives you a little bit of time, but in 30 to 45 days, I'm going to see if we are getting a little bit more movement into the upside in oil, and I'm going to strongly consider just getting out at that point in time. I'm buying more time so that I don't have to worry as much about the battle against time decay, and also, get a little bit better delta, right? So I do have to worry a little bit about implied volatility. Implied volatility is right around 35%, but across all underlyings, implied volatility is a little bit high. So it's really hard in this marketplace to just pick underlyings with low volatility. Yeah, they just really are not moving. So this is where we are at. The paper trade for this week, let's go back and rehash. We are looking at USO on Tuesday mornings. The markets are rocking and rolling. The last trade on the underlying stock or ETF is 67.85. It's up $1.60 on the day, and we're seeing a little bit of a bump up in the actual futures contract. Right now, we have the market at 545 by 590 on the 70 strike call that expires July 21st, 2023. It is 143 days to expiration. So if we place this paper trade, we would be looking to pay around $5.75, fairly close to the midpoint, plus commission. And that means for one contract, we would have $575 of risk, and obviously got to add in the commission on that trade. We have 143 days to that expiration date, but we're going to be looking to possibly get out of the trade between 30 to 45 days. We erred to the side of giving more time than our forecast or our outlook, but there's the rationale that's behind it has a lot to do with time decay. All right, so that's it for this edition of Options Playbook Radio. If you have any questions you'd like me to discuss on any of our huddle ups that I do with Mark Longo and myself, please send them to theoptionsguy@invest.ally.com. If you'd like to know more about what we do at Ally Invest, the best thing to do is just follow me on Twitter. My handle is very simple. It's at my name, at Brian Overby. And we'll see you next week, same time, same place. Until then, may all the options you bought finish in the money and all the ones that you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.